The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Money never sleeps, pal.
Okay, so Thursday the 9th feels like a more positive backdrop. Some nice upbeat commentary coming through. The UK have held interest rates stable and the world's feeling steadily more positive. Is that fair, Jeremy?
Yeah, I'd say so. I think the tenor of what we've been saying the last few weeks is beginning to feel like it's happening.
Mm-hmm.
I think quite a key moment was last week's Federal Open Markets Committee, the Fed decision. Well, obviously not the headline because rates didn't change. The key change sort of below the headlines was the slowdown in quantitative tightening. So the slowdown in the rate at which the Fed has been reducing its balance sheet. I guess the question is negative QT the same as QE? I mean, they're never going to call it QE,
Okay.
but it has the same effect. It frees up balance sheet capacity elsewhere in the bond market, which eases financial conditions, and it's good for risk assets. And what we've seen has been an easing of financial conditions and continuing strength of risk assets. And one measure of that was that the Bitcoin price rose 10% in 48 hours.
Mm-hmm.
And that is the ultimate risk asset driven by liquidity. So, yeah, things are better. And critically, I think from a global perspective, it has taken the pressure off the yen and abated concerns of an Asian currency crisis. Yeah, everything's looking a little bit rosier and, okay, fundamentals matter, but in the short term, markets are driven by liquidity and that's stopped being as negative as it was.
Okay.
This week's main economic data were going to be the Bank of England rate decision and tomorrow's GDP numbers. And again, looks like more positive than negative.
Yeah. So the US is keeping rates higher for longer by adding liquidity to the markets, and Japan seems to be okay for now.
Yes.
The upshot.
Yeah, absolutely. Yeah.
Okay.
And the UK, similarly, headline rates have remained the same.
Yeah.
The MPC voted 7-2 to maintain 5.25% as the guided rate. But 2 MBC members voted for a cut today. And the market is now saying that it's a 50% chance we will get that cut in June.
Mm-hmm.
So just to put it into context, what Andrew Bailey said was that we will need to cut the rate over the coming quarters and make monetary policy somewhat less restrictive over the forecast period, possibly more so than currently priced into the market. So he's
clear.
Explicitly saying it's on its way, guys. And I would say implies lower mortgage rates, perhaps to the tune of 100 basis points over the next 9 to 12 months.
Mm.
So in the context of what Alistair was saying last week about the positive noises coming out of the housing market, it remains a very pertinent view to take, I'd say.
Yeah, mortgages 1% lower would make a big difference to a lot of people. Whether it's in time to save the Conservative government, probably another matter.
I'd say almost certainly not. Jeremy Hunt has been saying for a little while now, the feel-good factor is on the way, and this is power to that point of view. But I think it's too little too late.
Yeah.
What it might do is tempt Sunak to go for the election later rather than sooner.
Mm-hmm.
I think the balance of probability is now it goes back to later in the year.
Okay.
I guess then the next question is about whether the MPC, whether the Bank of England will actually be prepared to cut rates ahead of the Fed. Perhaps my concerns on that front have been a bit misplaced. They might choose, along with the ECB, to go early. This week, Sweden cut its interest rates for the first time in 8 years. And we already know that back in March, the Swiss National Bank cut their rates. So in that sense, we wouldn't be going it alone. But, we've had more recent issues than maybe some other currencies, and we might be a bit nervous on that front. But right now, the market's not worried about that. And I think it's saying we're getting rate cuts and it's all feeling a lot better.
Yeah, it certainly feels that way. And so equity markets have responded positively to this backdrop that you're describing then?
Looks like it. And it does seem to be filtering down to the mid and smaller cap areas of the market, which obviously we keep a closer eye on. We've had trade data from China overnight, which were consistent with a continuing manufacturing recovery from China. Chinese equities from their low point of March are up now over 20%. And it would appear that China is dealing with its economic and financial issues in a sensible and methodical manner, which means we in the West will be able to import lots of deflationary goods like very cheap EVs, solar panels, wind turbines, all that good stuff, assuming that the politics will allow us to do that. But for the time being, at least, the world is importing more deflation from China, which will be beneficial.
Yeah, that would be a good thing. And if they can manage their economy to some kind of recovery in a steady and balanced way, that would be positive for us all. I haven't seen any headlines too recently about Chinese property companies going bust or massive loan defaults. So it feels like they're just gradually working things through. If that means, as you say, that we can keep importing cheaper infrastructure assets or probably goods more than services, then that would be useful for our economy.
Absolutely.
I saw there was a bit of divergence between the French and the Germans in terms of what they were looking for, with the Germans wanting to defend their car making industry and the French being very keen to import, as you say, the Chinese deflation. So it'd be interesting to see how Brussels manages that tricky line and walks the tightrope there.
Absolutely. I think it's going to cause a lot of problems, a lot of issues for a lot of people. I mean, it's really put the pressure on the global auto manufacturers. But there's going to be all kinds of political ramifications here. But overall, the world economy is doing okay. Inflationary pressures are still there, but they're probably abating. And it looks like rates are heading down. So that's a pretty good combination.
It is. Yeah, certainly feeling quite good. And how's that translated into the UK small mid-cap stocks and anything that you've seen this week from companies reporting? What's caught your eye?
I think being a short weekend, I guess people are probably favouring to make announcements, not necessarily in this week. So it's been reasonably quiet. Things that caught my attention were Informa, which is a B2B media provider, had a trading update and said its businesses were performing ahead of or in line with 2024 targets. And it's increased its share buyback programme by 50% to £500 million. So we've got this retirement of equity story from the UK mid-market continuing. But the other thing it said, it had struck a deal with Microsoft worth £10 million over a number of years for AI purposes, which is an interesting trend we're seeing among data providers in the B2B space. AI is looking for high quality curated data. And the UK's got a decent number of companies in this space that I think can look to monetize its data. So I think looking at the media sector as a source of value with an AI tag is going to be increasingly apparent in coming months.
Everyone's talked about data being, the new oil or whatever it might be, and that there's huge value in data. And I suppose most people had always expected that value or that monetization would be by the companies that own and have the data and improving their own performance, selling more efficiently or driving better margins or just doing well as businesses because of their own data. But being able to sell it in this way to the AI superpowers, that's a new opportunity. Yeah. Interesting to see.
Yeah, and I think how AI is embraced and adopted is going to be a key element of how we overcome some of the structural inflation issues in the wider economies.
Yeah.
We had a trading update from Wetherspoon.
Always fun.
Yeah, always fun hearing from Tim Martin. Uncharacteristically short and sweet, but it remains positive. Saw like-for-like sales increase by over 5% in the last 13 weeks to the end of April. And he said that the gods of fashion have smiled upon Guinness, previously consumed by blokes my age, but now widely adopted by younger generations. Yeah. He also added that free coffee refills are thought to be responsible for spontaneous exhibitions of breakdancing among retired customers. So
something for everyone. Yeah.
But so always a sort of colourful turn of phrase, but the Guinness point made quite a few headlines, but it is noticeable, and I have read it elsewhere, that the fastest growing demographic of Guinness consumers, I think, is the female demographic aged 18 to 35 or something like that. So,
So good to see. And if it's good for Wetherspoons, then that's good for most people. So it's nice to see that coming through.
And elsewhere in the leisure spend area, there's a tiny company called XP Factory, about a 40 or 50 million market cap. Used to be known as Escape Hunt.
Oh, yes.
But it has now combined with, I think they call it Boom Battle Bar, but it's basically an experiential leisure environment where people can throw axes at the wall and drink beer at the same time.
No risk there.
What could possibly go wrong? But this thing is growing absolutely like a train and has continued to demonstrate very strong double-digit growth. It's one of those stocks that the market doesn't seem to really care about much. But one day, if it continues to pursue this growth theme that it seems to have got, if it continues to replicate and roll out these venues as it has been, then we'll be hearing about this as a much bigger company in the future.
One to keep an eye on. Yeah, absolutely. Okay.
We've had ITV report today, I think it was, that their advertising revenue grew nicely in Q1, but accelerated into Q2 to up around 12%. ITV is one of those bellwether stocks, so people are advertising more, and I think there are wider implications of this trend. Clearly, if people are wanting to advertise more, then by definition, think there's business to be won out there. It's a positive thing. So I think that has wider implications. So
yeah, it's good to see.
Including north of the border, of course.
Yes. Our progressive client, STV, hopefully will benefit from some of that positivity and the improvement in the advertising landscape. It'd be good to see. And as you say, that is a good barometer of corporates' view of the world, and whether it's worth spending on advertising depends largely on your view of whether people will be spending in your bars, restaurants, pubs, whatever they might be, or buying your products and services. So it's good to see that showing through as well for ITV. Okay, what about next week? What have we got coming up on the calendar?
Tomorrow, we've got UK GDP data, which I think should allow for headlines about the UK's shallow recession of last year or near miss, depending on how these figures come in and how people choose to interpret them. And of course, how the prior period numbers are reinterpreted. But Q1 this year on year GDP growth is expected to come in at around 0.3 of 1% annualized rate. Doesn't sound great. Q4 last year was at minus 0.3. So we had 2 quarters last year of marginal GDP declines. And this is going to be followed by a period of recovery. So I think the headlines could and should be more positive on reflection of that.
Yeah.
Into next week proper, we've got UK unemployment rate being delivered for March, which is probably going to show an unchanged figure of about 4.2%, but worth keeping an eye on. We've also then got US inflation data. We've got producer price data on Tuesday for April, which month on month will probably show an unchanged figure. Interestingly, on Tuesday next week, we've got inflation data for April for Argentina.
Okay.
It's forecast for April going to be running at a rate of about 300% year on year.
Wow.
But I was just looking at the long-term chart. Actually, 300% barely registers on the long-term 50-year chart of Argentinian inflation, which peaked in March 1990 at a rate of just over 20,000%.
Okay.
And I think if you look at that chart, you understand why they basically elected a president who ran on a ticket of scrapping the financial system and trying to start again. So
yeah.
That's going to be an interesting one, longer term to follow, I think.
He certainly made some waves, so it'll be interesting to see if he can deliver against the promise. Yeah, absolutely right.
But back in the developed world, on Wednesday, we get US inflation measure for April, which should show slightly slower rate in headline and core measures for the month or year on year, but it still looks pretty marginal. So the headline year on year rate is probably going to be 3.5% there or thereabouts. So unfortunately, I think the idea of sticky inflation in the US is going to be with us for a little while longer yet. And that begs the question of how that impacts the dominant dollar, the high level of dollar interest rates, and the impact that has on currency volatility, and whether in that context, we and other people like the ECB will really have the bottle to reduce interest rates come June. But let's hope.
Yeah. Okay. Well, let's look forward to next week. We'll have some more information to help us guess the outlook for both UK rates and others going forward. So brilliant. Thank you very much. Great wrap up. And we'll catch up this time next week. Okay. Thanks a lot.
Okay. Look forward to it.
Brought to you by Progressive Equity.
This is your wake-up call, pal. Go to work.